In this video, we are going to move on to a new topic, which is aggregate demand policies. Specifically, we are going to look at budgetary policies in this video. We are going to discuss the budget outcome, which includes outlays and receipts. Outlays means expenditure, receipts means the collection of government revenue. We are also going to look at stabilizers and what does stabilizer means. Specifically, automatic versus discretionary stabilizers. We are also going to talk about the strengths and weaknesses of budgetary policies. So let's begin. So what is the definition of budgetary policy? So it is the manipulation of the level and composition of receipts and outlays to stabilize business cycle and achieve macroeconomic goals. So this is really important. So let's firstly try to understand this sentence. So the level of receipts and outlays refers to how much you spend as government expenditure and how much money you collect as taxes. And composition means what type of tax do you prioritize collecting? Do you prioritize company tax or individual tax or goods and services tax, etc.? And how do you spend those money? Is it spending on health, on education, or on defense? So that's something that the government can change. And the manipulation of the level and composition, these are referred to as discretionary stabilizers. So it is something that the government did on purpose. There's something that also occurs automatically, which we'll discuss later, and it's called automatic stabilizers. And why do we call them stabilizers? Because the aim of budgetary policy is to stabilize business cycle. Remember that business cycle refers to the fluctuation in the GDP output over a long period of time. But we do not want this fluctuation because this means that sometimes there's no unemployment, sometimes they have a huge amount of people unemployed. So we want to have this stable economic progress. And the goal of budgetary policy and also monetary policy, which we will discuss in the next video, is to give the economy a smooth increase in aggregate demand, in GDP level. So that's what we mean by stabilizers. So the tools that government use to stabilize the business cycle. And the overarching goal of budgetary policy and monetary policy is to achieve the domestic macroeconomic goals, which we know is the goal of SSEG, strong and sustainable economic growth, the goal of full employment, and the goal of low inflation. So as you can see here, everything we have discussed in Unit 3, Area of Study 2, all comes back to Unit 4, Economics. So that's the connection between different areas of studies, and that's what most students found difficult because they are unable to establish this link across areas of studies, and so they are struggling to gain high marks in the exam. If you want to have high marks, you need to link all those different concepts together to give a cohesive answer. So first, let's look at why do we need aggregate demand policies to stabilize business cycle. So by aggregate demand policies, I mean budgetary policy and monetary policy. So today we are focusing on budgetary policy only. So we know that we have this business cycle with periods of boom and periods of trough. And those kind of fluctuations is not sustainable, it's not healthy. So we want to use the aggregate demand policies in a counter-cyclical manner to stabilize the cycle. So what does counter-cyclical means? So during boom, you are trying to use policies to slow down the economy. So when the economy is running very hot, you want to slow down the economy. When the economy is very low, very weak, you want to speed up the economy. So you are kind of opposing this motion of business cycle. So you don't want the boom to become too high, and you don't want the trough to become too low. So in essence, you're trying to reduce this kind of fluctuations by applying your policies in kind of reverse order to what the economy is naturally doing. So for example, when we have high inflation, high GDP growth, we want to artificially slow in the economy down. When we have a depression or recession, we want to artificially speed up the economy. And so we can achieve a more smooth rate of economic growth. And this smoothing out of fluctuations protects the well-being of Australians. Because when you look at things like unemployment rate, it's not just a number, it's people's livelihoods. When you are unemployed, it could be devastating for individual people or individual families. So we really don't want this kind of huge fluctuations to occur in the economy. And we want to protect the well-being of everyone in the economy. So that's why we want to use aggregate demand policies to stabilize the fluctuations. So just because we are talking about budgetary policy, we need to know where does the money come from. So the source of government revenues. So there are multiple sources. The first one is income tax, which is a very big source of revenue in Australia, but not the case in other countries. We can have company tax. We can have excise tax. So basically two things, tobacco and petrol. That's the two main contributors to excise tax, and to reduce or counteract this effect of negative externality. Or we can also sell government enterprise, so privatization. So if the government sells Australian Post, it becomes government revenue in that period. So because we are talking about tax is separated into two parts. We have direct tax, we have indirect tax. So direct tax is tax on income. So either it's personal income tax or company income tax. Or indirect tax is the tax on the sale of goods and services. One example is goods and services tax. So that's just something you need to know. So that's where the money comes from. So how does government spend those monies? So this includes social welfare. So that's actually a very big component. So things like unemployment benefit or pension, things like that. Spend money on health, on hospitals, on infrastructure, to build a new airport or a new subway. And there's two types of expenditure. So we have current expenditure, which is payments of goods and services consumed in current period. So usually within 1 year, and there's no ongoing economic benefit. So examples include payment of wage to public servants. So once you pay those wage to public servants, there's no ongoing economic benefit to the economy or to the government. There's also something called capital expenditure. So as you can imagine, it is things with ongoing economic benefit. Examples include schools, roads, things like that. So if you spend money in this period to build a new school, there's ongoing benefit to the economy in the future as well. We know where the money comes from and where the money goes, so we can form an overall picture of a government budget. So there's something called budget outcome. So after this kind of planning or projection into the future, or we can also look past and see how much money government collected, how much money government spent during the year, and we arrive at something called budget outcome. So what actually happened. So if outlay, so how much you spend, equal to receipts, how much you collect in a balanced budget. So the budget is balanced. If outlay, so how much you spend, is bigger than how much you collect, you have a budget deficit. So this is usually the case for many governments. So government is spending too much money. Conversely, if the collection of tax is higher than government spending, you have a budget surplus. So Australia used to have many years of budget surplus during the mining boom. And the accumulation of budget deficit becomes government debt. And the accumulation of budget surplus becomes government's claims to other debts. So government may have deposited money in a bank, and this is government claim to some type of asset. But in many countries, we have government debt instead of government owning things like financial assets overall. There are also two ways to measure budget outcome. So the first way is to use headline budget outcome. So this is calculated by subtract outlays from receipts. So everything that government have spent minus everything that government have collected. Although this looks like a very good way to measure a budget outcome, but it is actually not the case. Because in some years, we may have one-off items, such as the sale of national enterprise. So this will artificially increase the receipts But this is not really a structural component of the budget because this is one-off. And maybe you can sell one national enterprise this year, but not necessarily can sell one next year because there's only so much national enterprise you have. So a better indicator is called the underlying budget outcome. So this is what you would see in the budget paper, is the underlying outcome. So this is calculated by removing one-off items from the headline figure. So it is a better indication of the position and impact of budgetary policy. So maybe the budget contains a lot of spending initiatives, so what we call expansionary. But because of a sale of national enterprise, suddenly the budget looks contractionary. But this is not what we want. We want an accurate description of the effect of budget on the economy. So once we exclude this one-off event, we arrive at the underlying outcome, which is a much better indicator of the effect of budget on the economy. Also, another two measure. So one is called the net operating balance. So the net operating balance focus on the revenue and receipts that are incurred and earned. So this is really an accounting definition. So suppose you have incurred $100 of expense on the 31st of December 2024. But because it's the last day of the year, maybe you will pay this invoice next day, so the 1st of January 2025. If we use the headline or the underlying outcome, this $100 of expense will not be included because the money haven't go out of the bank account on the 31st of December 2024. So it will be counted in 2025 calendar year. But for the net operating balance, it would be counted on 2024 because you have already incurred this expense. Although you have not paid, but if you incurred the expense in 2024, then it will be recorded as expense in 2024 rather than actual payment which occurs in 2025. So this is really not that important. Usually the underlying figure and the net operating balance would be very, very similar. But what differs is that it excludes spending on capital assets and include depreciation. So spending on capital assets is not included, but depreciation is included. Generally speaking, the figures are very close, so within a few percentage point of each other. But this is an indicator of the sustainability of the budget. Because generally speaking, spending on capital assets like road, hospitals, machineries, they can produce long-term economic benefits. So if we exclude those things that can produce long-term economic benefits, we arrive at a figure which shows like the current spending by the government. So the spending that would not have overall ongoing impact on the economy. So it indicates the sustainability of the budget. If we have a very negative net operating balance, then in the long term, this means we are not investing enough in assets that can actually generate income and all spend all the money in the current period. So this indicates the budget is not sustainable. So how do you finance a deficit? Whenever you have a deficit, you need to find money. So how do you find money? This is done by issuing a government bond. So government bond is government borrow money from investors. And this can be issued to two different parties. So overseas investors and domestic investors. If government issues government bond to overseas investors, this would increase demand for Australian dollar because the Australian government borrows in Australian dollar. And if overseas investors want to purchase Australian government bond, they need to convert their currency to Australian dollar. So they need to buy Australian dollar. And this represents demand for the dollar. And we know that this would cause appreciation. So the value of the Australian dollar goes up, which is bad for exporters because it decreases the international competitiveness of export. So from foreigners' perspective, suddenly Australian-made goods and services becomes more expensive. And so this makes the exports less competitive and bad for aggregate demand. So it is not a good thing. For domestic investors, this would cause a problem called crowding out. So there's only so much money available in the economy. And if government borrows a lot of money from the economy, then there's less money for private sector to borrow. And this would cause increase in interest rate because government is also competing for money. And usually people like to borrow money to the government because it is usually very, very safe. So the default risk, the risk of not getting your money back by borrowing to the Australian government is very, very low. And higher interest rate, as we know, discourages investment. And this would shift AD to the left. And also it's bad for the aggregate supply because the private sector cannot invest in machineries that can increase productivity of the economy. So the Australian government have already borrowed a lot of money. So almost $1 trillion of debt. And this is problematic. So it reduces the ability to borrow more in the future. Because you already have $1 trillion of debt, people are worried about the ability for government to finance or to repay the interest on that debt. And so when another recession comes, the government is less able to borrow large quantities of money to stimulate the economy. And this may also reduce the credit rating. So currently the Australian government have the credit rating AAA, so it is the highest rating. High rating means low rate of default, and this means you can borrow at a cheap rate. And if you have too much debt, then maybe people think the likelihood for you to default would increase. And this decreases the credit rating, and meaning you need to pay more to borrow, higher interest rate to borrow in the future. And this can increase future interest rate and can even increase debt further because you need to pay a greater amount of interest. So if the budget is in surplus, then government can repay the debt and increase the borrowing capacity to respond to future economic shocks. So now let's move on to another related topic, and this students usually find most confusing, which is automatic stabilizers. So the concept itself is not difficult. I think it's just the name is a little bit confusing. So let's start with the definition. So automatic stabilizer is the cyclical component of the budget that changes automatically following changes in the level of economic activity. So let's unpack this definition a little bit. So whenever you see the term cyclical, then you know it refers to business cycle. This is always the case. And it's changes the budget automatically following the change in economic activity. So let's have a look of why this is the case. Whenever you have a business cycle, you have a peak or boom, and you have trough or recession. And because of government welfare and tax collection, whether you are at peak or trough actually changes the level and composition of your receipts, which is money coming in, and outlays, which is money going out. And it changes automatically in a counter-cyclical way without any government intervention. So by counter-cyclical, I mean when the economy is running too hot, the automatic stabilizer actually acts in a way that slows the economy down. And when the economy is very weak, the automatic stabilizer actually acts in a way that speeds the economy up. So it is counter-cyclical, so it goes against the business cycle. And this is very positive because when the economy is running hot, it slows the economy down. When the economy is at recession, it speeds up the economy. So you get this smoothing out of business cycle. And that's why automatic stabilizer is a desirable property of the government budget. And that's why budget or budgetary policy is very important part of a domestic macroeconomic management policy because it have strong impact on the level of economic activity. So let's look at two scenarios. So the first scenario is during peak. So during periods of very high rate of economic growth. There are some characteristics associated with peak. So first, you have low unemployment rate, and we have already covered this before. When you're at peak, you have strong activity. Strong activity means more production. More production means more demand for labor. More demand for labor means lower unemployment. A lower unemployment rate would mean two things. So the first thing is you have less people qualify for unemployment benefit. And this means you have less outlays. So the budget is spending less money on welfare. Also, you have more income because more people are earning income, and thus more income tax collected. So you have more receipts. And the second thing is more corporate profit. And this is associated with more company tax. So now you have more receipts. And remember that receipts represents money that is going into the government. So this is very similar to savings. So money is leaving the financial system, leaving the economy, and used or being saved by the government. So you have more money leaving the economy and less money going into the economy via unemployment benefits. So overall, this is actually contractionary. So essentially, you are taking money out from the economy. You have more receipts, less outlays overall, and it slows the economy down. Or in other words, make the budget less expansionary. So expansionary means the budget stimulates the economy, and less expansionary means it stimulates the economy less, or conversely, more contractionary. So it slows down the economy even more than before. Depends on how you look at the problem, they are equivalent description. Thus, since you have more leakages, less injections, the budget becomes less expansionary, thus slow down the rate of aggregate demand and economic growth. So the opposite things happens during recession. So here, as you can see, during peak or boom, the automatic stabilizers actually helps to slow down the economy. So that's what I mean by smooth out this curve. It does not allow the economy to overheat as much because of this automatic operation of the budget. Now let's look at what the case under recession. So during recession, you have this increase in unemployment. And similarly, it corresponds to two things. So you have more unemployment benefit, which is the outlay of the budget. And you also have less income tax because either people who are previously employed becomes unemployed, so they are unable to pay income tax, or people who are still employed get a pay cut, so they are not unable to pay as much income tax as before. So this corresponds to a decrease in receipts or the decrease in revenue of the government. Also, you have less company profit, and this means a decrease in corporate tax, which is also a decrease in receipts. So overall, you have less receipts and you have more outlays, which is the injections. So overall, you are injecting or you are putting money into the economy. And so the budget becomes more expansionary or less contractionary, which helps to speed up aggregate demand and speed up the level of economic activity. Keep in mind that all those processes occurs automatically, and that's the powerful part of automatic stabilizers. So government does not need to do anything, and the budget itself helps to stabilize this business cycle via the collection of income tax and also the payment of welfare or unemployment benefits. So now let's discuss the stance of budgetary policy. So I have talked about the idea of being more expansionary or less contractionary, but haven't actually discussed these two terms in detail. So let's now have a look. So by expansionary, I mean budget deficit. So if the budget is in deficit, then it is expansionary because money has been pumped into the economy. Overall, you have more injections relative to leakages. Contractionary corresponds to budget surplus. So overall, you are having more leakages, which is government revenue, and less injections, which is government outlays. So overall, you are slowing the economy down. And by less expansionary, I mean you have less deficit. So compared to the previous budget, if the new budget have less deficit, then relatively speaking, you are injecting less money to the economy. So it becomes less expansionary. And similarly, less contractionary means you have less budget surplus. So overall, you are not take as much money from the economy as you have before. And more expansionary is more deficit. So you are pumping even more money into the economy than before. You can also have something called discretionary stabilizers. So the discretionary stabilizer is the policies by government designed to change the level or composition of receipts and outlays of the budget. So that's what we really mean by budgetary policy. So each year you have a government budget, and in this budget you have some spending initiatives. you have maybe tax cuts, you have all sorts of different policies, and those things are designed to artificially change how much money government receive. And how does government collect those money? Is it through a higher income tax, or is it through a higher tobacco tax or a higher fuel tax? So all those are discretionary or deliberate change by the government, and they can have different impact on the economy. Similarly, for tax cut, it is also a part of budgetary policy. And if the tax is reduced, then the government is collecting less money, so the budget becomes more expansionary or less contractionary. And because each year we have different policies, I can't really say any of the policy in this video because it will become out of date very soon. When you are approaching the exam or when you are studying this topic, make sure to go to the government budget website and look through some of the policies that government have introduced in this year, and think about how it affects the goal of SSEG, the goal of low inflation, and the goal of full employment. Remember, SSEG is just linked to GDP growth. Low inflation is linked to inflation. Full employment is linked to unemployment. And generally speaking, GDP and unemployment, they go together. If some policy is designed to increase the level of spending, it can increase aggregate demand, thus increase the level of activity, economic activity. And this can reduce unemployment rate. So SSEG and full inflation, they go together. And for the goal of low inflation, maybe the policies designed to speed up the economy can actually undermine the goal of low inflation, because any policy that increases aggregate demand would increase inflation as a result. And as we will talk very soon, a weaknesses of budgetary policy is that government may have political agendas to win vote rather than actually caring about the economy. So even if inflation is very high, the government may still introduce tax cut, because a tax cut can help to win vote from voters, but it can even cause further level of inflation as people increases their consumption following a tax cut. So now let's look at the strengths and weaknesses of budgetary policy. So let's talk about strengths first. It have low impact lag. So I will abbreviate budgetary policy as BP. So budgetary policy can impact the economy in a very short period of time. So for example, if you have tax cut, it have immediate impact. Immediately after the budget have passed the parliament, the government collects less tax, and so you have more disposable income, the consumption increases, economic growth increases. So it can happen overnight, very, very fast. And for monetary policy, which we will discuss in the next video, it has a very long impact lag. So it usually takes years for the policy to actually take effect or impact the economy. It has the ability to target specific sectors. So for example, we can have tax cut to small businesses, or tax cut to workers, tax cut to big companies. We can have subsidies to companies, subsidies to household. So it's really flexible and can target really, really specific sectors. And this is not the case for monetary policy. If interest rates have decreased, then everyone would have impacted. The last strength of budgetary policy is that it automatically swings into action. So this is what we mean by automatic stabilizers. So even the government does not do anything, the budget would automatically help to stabilize the economy. So this is really a very powerful aspect of budgetary policy. Of course, it can also have many weaknesses. So the first weakness is the long implementation lag. It's very important to distinguish between impact lag and implementation lag. Impact lag refers to how fast the policy can affect the economy, but implementation lag is how fast the policy can be implemented. So the reason why budgetary policy have long implementation lag because we need approvals. So we need cooperations with things like state government. So if state government want to delay the project, then the project may never be actually implemented. Also, you may need to undergo parliamentary approval. So you need to be approved by parliament, which is also a very lengthy process. So although once approved, the policy can be effective, but this approval process may take years, may take few years in some instances. So that's one of the weaknesses of budgetary policy. And for monetary policy, which is interest rate, it have very short implementation lag because the interest rate changes immediately after the announcement. But the impacts of this interest rate change can take very long to affect the actual economy. So another issue I have already mentioned is political bias. So it is used to buy vote. One example is the energy subsidy. The government wants to increase its popularity by having this energy subsidy, but it actually helps to increase the rate of inflation rather than helping the economy to reduce inflation. So this is an inevitable weakness of budgetary policy because it is an economic document, the budget, but it is also a political document. So that's why it may suffer from very severe political bias and may actually harm the economy. So some policies that people want may actually harm the economy, like tax cut, like subsidy. So all those things may be harmful to the economy when we already have a very hot economy with a very high rate of inflation.